Hey everybody, I appreciate you watching my videos. If you like what you're hearing, please give us a thumbs up and make sure you subscribe to this channel. Also, put a comment in the comment section below, and that can help us to decide what direction this channel will go in the foreseeable future. Now, watch the video. Hey everybody, it's Otis McAlaster with Keller Realty Roanoke and the Hogan Home Team, your knowledge broker for buying and selling in the Blue Ridge. And some of you that are watching this video are thinking about buying a home right now. Now you might have the great fortune of having enough cash on hand to be able to buy that property cash, and that's a wonderful thing. However, for some of you, that's not an option. And what you're going to need to do is to get a home loan or a home mortgage. In order to do that, your credit score is going to have a great deal to do with that. Now for some of you, you can feel like, hey, understanding your credit score requires an advanced degree in mathematics or something. You've got to try to figure out what's affecting your credit score. But I've got good news for you. You really don't need all that. All you need to do is just understand a few rather simple principles. Now behind the numbers themselves, which generally range from 300 to 850, there are 5 main factors used to calculate credit scores. Lenders use those scores to figure out how likely you are to pay back that loan. Thus, those scores are often the deciding factor in whether or not you're going to get the loan. As your financial profile changes, so does your score. So knowing what factors and types of accounts affect your score gives you the opportunity to improve it over time. Now overall, there are top 5 factors that affect your credit score. Now while exact criteria used by each scoring model varies, here are some of the most common factors that affect your credit score. The first factor is payment history. Payment history is the most important ingredient in credit scoring, and even one missed payment can have a negative impact on your credit score. Lenders want to be sure that you're going to pay your debt back and pay it on time when they are considering giving you new credit. Payment history accounts for about 35% of your FICO score, and the credit score is used, this FICO score is used by most lenders. The next top credit score factor is credit utilization. Your credit utilization ratio is calculated by dividing the total revolving credit that you're currently using by the total of all your revolving credit limits. The ratio looks at how much your available credit you're utilizing and can give a snapshot of how reliant you are on non-cash funds. Using more than 30% of your available credit is a negative to creditors. Credit utilization accounts for 30% of your FICO score. The next factor is credit history length. How long you've held credit accounts makes up about 15% of your FICO score. Now this includes the age of your oldest accounts, the age of your newest credit accounts, and the average age of all your accounts together. Generally, the longer your history, the higher your score is. Number 4 on that list is new credit accounts. The number of credit accounts you've recently opened, as well as the number of hard inquiries lenders make when you apply for new credit. This accounts for about 10% of your FICO score, and too many accounts or inquiries can indicate an increased risk, and as much can hurt your credit score. Okay? People with top credit scores often carry a diverse portfolio, and this is factor number 5. A diverse portfolio accounts include things like car loans, or credit cards, or student loans, or mortgages, or other types of credit products. Credit scoring models consider the type of account and how many of each have an indication of how well you've managed the entire range of the account products that you have. Credit mix accounts for 10% of your FICO score. The next thing we want to talk about is type of accounts and how that impacts your credit score. Now typically, credit file contains information about 2 types of debt. That's installment loans and revolving credit. Because revolving and installment accounts keep a record of your debt and payment history, they are important in calculating your credit score. Installment credit cards usually are companies that loan you where you can borrow a fixed amount and agree to make a monthly payment towards the overall balance until the balance is paid off. Student loans, personal loans, mortgages are example of installment accounts. Now, revolving credit is a different type. Revolving credit is typically associated with credit cards, but it can also include some types of home equity loans. With revolving credit accounts, you can have a credit limit and make a minimum payment on a monthly basis. And according to how much credit you use, revolving credit can fluctuate and doesn't typically have a fixed term. Quite often when talking to different clients, I'm asked the question, how does different accounts affect my credit score? So now what we're talking about is credit mix or diversity of your credit accounts. Now, diversity of credit accounts is one of the most common factors used to calculate credit scores. It's also one of the most overlooked by most consumers. A lot of times when people are trying to build their credit score, they will go out and they will get the same type of credit scores over and over and over again, such as they'll open a whole bunch of different secured credit cards or other types of credit, but they'll do the same thing over and over and over. So now, this is not really the smartest way to do it. Maintaining different types of credit accounts, such as mortgage, personal loans, and credit cards, shows a lender that you can manage different types of debt at the same time. And it also helps you to get a clearer image of your finances and gives them a better understanding of your ability to pay back debt. So now, while having a less diversified credit portfolio won't necessarily cause your score to go down, the more types of credit you have, as long as you make them on-time payments, the better it is. Credit mix accounts for about 10% of your FICO score and could be an influential factor in helping you achieve a top score. Another thing that people want to talk about is, can a service account impact my credit score? So generally when they're talking about a service account, they're talking about their phone bill or perhaps their electrical bill or some other type of utility bill. Service accounts such as utility bills and phone bills are not automatically included on your credit file. And historically, the only way a utility account could impact a credit score was if you didn't make the payment and the account was referred for collection. However, this is changing. There is a revolutionary new standard that's going around, and there are a lot of companies that are coming out that will, for a fee, report these on-time payments from different utility companies and different other types of utility accounts to the credit file so that you can get credit for it. Now, you'll have to go online or search other information, or you can call me and I can direct you to companies that might be able to help. Generally speaking, it doesn't take long when you start talking about things like this that someone starts asking you about how to improve their credit score. So now, improving your credit score can be easy once you understand why your credit score is struggling. It may take time, effort, but developing responsibility and responsible habits can help you to grow your credit score. And it may not necessarily take as long as what you might think. A good first step is to get a free copy of your credit report. You can go to freecreditreport.com and you can get a copy. You can also get a copy if you've been denied credit in the past. Your score will help you to understand your credit file. You want to focus on what is bringing your score down and work towards improving those areas. Now, here are some common steps that you can take to increase your score. And the reason why a lot of people ask me about these things is, number one, there's just a lot of folks out there that have bad credit. And number two, I've had some success with being able to help some clients in the past. And that's why I'm giving out this information, and I'm hoping you can utilize it. So first of all is pay your bills on time. Now, I know that sounds like a no-brainer, but obviously not everybody does that. Because payment history is the most important factor in making up your credit score, paying your bills on time every month is critical to improving your credit score. Another thing that you can do is to pay down your debt. Reducing credit card balances is a great way to lower your credit utilization ratio and can be one of the quickest ways to see your credit score boost. Remember, this is an extremely high portion of what they use to make your credit score. Making any outstanding payments is also another great tactic. So now if you have any payments that are past due, Bringing those up to date may save your credit score from taking even bigger hits. Okay, late payment information in credit files includes how late the payment was, whether it was 30, 60, or 90 days past due. And the more that time has elapsed, the more that's going to affect your credit score. Another thing that you can do is to dispute inaccuracies and information on your credit report. Mistakes happen all the time, and your score can suffer because of these inaccurate information that have been put on your credit file. Periodically, you should monitor your credit report to make sure that there are no inaccurate information that appears on there. If you find something that's out of place, initiate a dispute as soon as possible. Finally, limit new credit requests. Limiting the number of times that you ask for new credit will also reduce the number of hard inquiries that end up on your credit file. Hard inquiries stay on your credit report for 2 years, though their impact on your score fades over time. Now, that being said, what do you do if you don't have a credit score? If you want to establish and you want to build credit, you don't have a credit score, there are some options. One of the things that you can do is you can get a secured credit card. A secured credit card can be used in the same way as a conventional credit card. And the only difference is that the secured credit card is secured by a deposit that's made against the card. Typically, it's equal to your credit limit, and it's required when signing up for a secured credit card. Now, the security deposit helps protect the credit issuer if you should happen to go default. And you use the secured credit card to make essential payments, like gas, or an electric bill, or other types of bills, and then pay off the full amount as soon as you have the money available to do that. All right? You can get a secured credit card at your local bank, or you can go online and find banks or institutions that will do a secured card for you. If you're having trouble finding those types of things, you can give me a call and I can walk you through and give you some suggestions on what you could do. Another thing that you can do is become an authorized user. Now, if you're close with someone who has a credit card or some other type of account, and they're open to it, you could ask that person if you could become an authorized user on their account. In this scenario, you get to take advantage of their credit history. Now, if they're smart, they're not going to give you access to the account, but they will allow you to take advantage of their credit history, and this could boost your credit score quite a bit. The bottom line is this: if you're trying to buy a home and your credit is not in the place that it needs to be, you don't need to lose heart. Credit can always be restored, renewed, or refreshed. You just need to create a plan that's going to get you there. One way that you can do that is to apply for the Renters to Homeowners program, sponsored and powered by the Hogan Home Team. In this program, we sit you down and talk to you about what your current situation is. We help you talk with some lenders, and we give you some options about different loan products that are out there. If your situation is not so that you can buy a home now, we help you to create a plan that's going to get you to home ownership, utilizing a lot of the different strategies that we talked about today. You don't need to lose heart. Home ownership is in your future, but you've got to buckle down and you've got to come up with a plan that's going to get you there. It's my job to help you do that, and I'd love to help you by sitting you down and giving you a buyer needs consultation. All you need to do is reach out, give us a call. One of our agents would be glad to sit down with you and help walk you through this process, including teaching you about the home buying process. So this has been Otis McAlaster with Keller Williams Realty Roanoke and the Hogan Home Team, your knowledge broker for buying and selling in the Blue Ridge, and I'll see you later.